How did you get this over the line in this current environment?
Yeah, I think look, one of the things we're proudest of is that we, over a long period of time, have been really consistent and I think pretty disciplined. We do one thing well, which is true early stage investing. And so while markets rise and fall and lots of things outside of our control happen in the background. We don't tend to get sucked into sort of hype cycles, it's sort of been reflected in our returns, and so we're fortunate that LPs continue to support us, and but let's say we're happy to have this behind us in this market.
Ben, we've discussed for many years how early stage companies and their investors are more like insulated from public markets and macro events until what happened with Silicon Valley Bank. And it became about operational cash flow, right? But you're still doing a new fund. There's reports about Andreessen doing a very, very big fund. Just talk to me about that environment more specifically at the early stage.
Yeah, and actually, I think the SVB crisis was, for certain funds, a wake-up call, where that was sort of coming out of a hype cycle in 21 where money was flowing very freely. Companies were raising lots of money and chasing growth at all costs. And I think even for us at LH, we took a moment to be very introspective and say, are we on a company by company by company basis making sure that folks are being really responsible and not falling prey to lots of late stage money chasing hot companies and driving some not great behaviors? And right now, as we sort of enter another moment of crisis, I think that some of the learnings from that last significant sort of blip have set at least our portfolio up in a way where we feel like we have arms around every company in the portfolio, where companies on a quarter by quarter basis are burning less and less, are just taking more responsibility for building really sustainable long-term businesses, and falling a little bit less sort of a victim to getting on the late stage VC, sort of hamster wheel.
What kind of companies? Where are the companies? And how much of an unlock has AI been? Because what hits my inbox all the time right now and is discussed in the zeitgeist is you don't need to learn how to code anymore. Previously, if you pitched at Y Combinator or something and you didn't code or have anyone on your team that was a computer scientist or engineer, that would be dead for you, that avenue. I think that's changed, right?
Yeah, look, I mean, our goal has always been sort of to find great talent as true early stage investors. That's the key to every investment that we make. And AI is going to be an unlock in every single industry. And frankly, if you're not leaning in incredibly heavily to AI as an existing business, or certainly as a sort of de novo startup, you're missing a huge opportunity to create efficiency and move faster. And the tools that exist now in terms of helping companies code and build product faster are unbelievable. There are companies in our portfolio that are writing less than 5% of code by hand at this point and are really just prompting and managing third-party AI software who are helping them with much smaller teams create unbelievable leverage in their business. It's really exciting, but it's also terrifying because it's moving so quickly, and we're kidding ourselves if we know how this all sort of where this lands and where the value falls and what is owned by the big large language models and what's going to be owned by application layer companies. And so, we take solace in the idea that we're going to back incredible people and they're going to navigate through this challenging environment, and we're going to be there to help keep them on the rails.
Big personal fan of Bauble Bar. I can imagine that's the sort of company that's having to think about its supply chains right now, Ben. But I go to that company because many associate you with consumer-focused tech. But you are exposed to enterprise. You've got fingers in the fintech space, in DeFi as well. You're across the board. But when you're looking at the consumer opportunity right now, Ben, how unnerving is that?
Yeah, so I think that, we've been talking to our sort of scaled consumer companies about tariffs and what the implications of this would, should be over the last several months. I think the best and most mature businesses have been planning for this and have, and have some mitigations in place. But the reality is that there are companies that this is going to punch directly in the face, and it's going to be unpleasant, and they're going to need to figure out how to manage through it. I think people are also, it's just so unclear. The floor moves by the hour right now. And so I think people don't want to over rotate and over respond and, decide that they're absolutely positively pulling out of China on a permanent basis. But it's something that companies are going to manage through. People had to manage through COVID, and we saw the best founders handle that.
Yeah.
Not easily, but survive and thrive on the backside of it. And the same is going to happen here. I really believe that the best founders find a way.
And Ben, you're known for investing right here in New York. Is that still the thesis?
Yeah, I mean, we are huge believers in New York. I grew up in New York. We started the fund here in New York on a sort of high-level bet that New York has always had unbelievable talent, but 20 years ago, that talent naturally matriculated first to Wall Street, and over time, that talent now wants to go work in tech. That's the biggest growth area that New York has seen over the last, decade in terms of job growth and company growth. We think it's going to continue, and we again see that sort of overlap of very early stage in New York as a competitive edge for us in a space where we have real right to win. So we're going to keep doing that.